will pay attention to the budget and projected income statement just to ensure that you understand the theory and exactly what is the difference between the budget and the projected income statement and what is the purpose of both of these documents. A budget is a future plan in written form to indicate the expected inflow or outflow of cash in figures. So a budget is where you draw up something of what you plan to do in the future in figures to say, I think this is all the money that will come into the business, into the bank account. So this inflow of money must be the cash that is deposited into your bank account, and the outflow is the cash that will go out of your bank account. And at the end of the period, you will look at the balance in your bank account so that you can determine what is the position of the business in the future. Will they be able to pay for all their expenses and liabilities? So what we do, we estimate certain outflow of money and inflow of money for the future. The purpose of the budget is to determine if the entity will have enough cash to pay for expenses and purchase assets at the end of the month. So this purpose is very important. You will write down all the possible money that you will receive in a month and all the payments that you have to make in a month. And then you look at it and you determine, will I have enough money coming into the business, cash, that I will be able to pay for all these expenses and that I will be able to purchase the assets that I want to purchase. The cash budget is prepared at the beginning of the financial year. Now, it differs from different businesses. Some businesses will work out a budget from the beginning of the financial year up to the end. So say, for instance, from the 1st of March up to the 28th of February the next year. So they will have 2 columns for 12 columns for every month: March, April, May, June. And in every month they will indicate how much money do they think will come into the business and how much will their expenses and payments for assets and liabilities be that will go out of the business. And the whole purpose of this budget is to determine whether we will have enough money at the end of the month so that we can operate successfully, that we can pay our expenses, our liabilities, buy the assets that we need to expand the business. The budget is used to make decisions and measures when the figures, with all these figures in the budgeted figures. So the decisions that they make is they look at the budget and they see, oh, in February, for instance, I am not going to have enough money to pay for all the things that I have to pay in February if I take into account how much money will come into the business. So what must I do? I must take steps immediately. So I must make a decision whether I'm going to ask the bank for a bank overdraft to cover me over February, or whether I will obtain a loan so that I will be able to pay for all these things that I have to pay in the month that I know I'm not going to have enough money. Okay, the projected income statement is basically like the income statement that you know. The only difference is this projected income statement will have 12 columns for every month of the year. So March, April, May, etc. So the 12 columns, and then the 13th column will be the total, and that is the figure that you normally put in the normal income statement. So what is the purpose of this projected income statement? It's to budget for all the income and all the expenses that we think we will obtain during the next financial year, so that I can look at the income and I can look at the expenses for each month and then determine, okay, there's a month that I'm not going to get enough income because it's, for instance, in January when people don't have money, and that means I must make provision to pay all those expenses in January. So I will have to obtain money, a loan. The owner will have to contribute more capital so that we will be able to pay for all the expenses. The purpose of the budget is to help the management to plan for future activities and how to allocate the resources between all the expenses, liabilities that I must pay, so that we can provide for all these activities and we will have enough money for all of it. A budget is a plan where you communicate information to all the people in the business. So everybody knows, the senior staff, that that's the maximum amount that they are allowed in their section to spend on, say for instance, purchases, to pay for salaries. So they can't go over the budget figure. Precautions can be taken when the expense is more than the budgeted figures. So that means that if we see that there is an expense in a month that we didn't plan for, you have to make precautions that it won't happen in the future again. It can be used as an internal control measure to ensure that expenses paid are not more than the budgeted expenses and income is not less than the budgeted income. So what they mean with the budgeted expenses is we have a column where we see every month how much the expenses for all the various items must be. As soon as you see an expense is more than the expense that you budgeted for, you must go and investigate immediately and see what is the reason for this, so that I can reduce it immediately and it won't happen in the future again. So for instance, say delivery expenses. We budget for 2,000, then suddenly it's 4,000. Now, if we didn't sell a lot more, so that we had to do more deliveries that increase the expenses, it means there must be another reason. So then we have to go and look at the guy that's driving the delivery vehicle, if he's using this vehicle for his personal use, and that's the reason why the expenses are much more than it's supposed to be. For the income, for instance, if we have a place that we rent out, then we know we should get 5,000 Rand every month. So if there's a month that we don't get this 5,000, we must go and investigate immediately. Why did this money not come in, so that we can determine what is the problem, and that we ensure that in the future it will not happen again. It could also help to identify opportunities to lower expenses. So in a certain time when we had problems with electricity, we told all the staff members to switch off all the electricity in the evenings and over weekends, and then we realized that we saved a lot of electricity that month. So now we can make it a rule that electricity is not allowed to be on in the offices when it's not in use, so that we can pay less expenses for this. It can also help you when you plan for the future to detect potential problems, and that you can determine immediately how you can correct these problems and take corrective measures. The purpose of the projected income statement is to budget to see what is the total income and the total expenses for the financial year, and to determine if we have enough income to pay for the expenses every month. So in the projected income statement, you will only write the amounts that is the total amount that I'm supposed to get for the income, even if I didn't receive it. So it's the same in a normal income statement. The expense that it should be if nothing is prepaid or accrued. The income that it should be if there's nothing accrued or prepaid. Okay, there's certain amounts that you will find in the budget, but you will never find it in the projected income statement. So in the income statement, we only write income and expenses. So it means if I buy cash assets, whether it's inventory or other assets, fixed assets, it will never appear in the income statement because it's not expense. This will appear in the budget because it's money going out of the business. Payment of liabilities will not appear in income statement. It's money going out, so it will be in the budget. The payment of expenses, so the actual expense, what it should be, will be in the projected income statement, and in the budget you will show the amount that you already paid. So say for instance we pay 1,000 rand rent a month, and then we already paid 1 month in advance, so in the budget you will show the rent as 13,000. In the income statement you will show the rent as 12,000. Okay, amounts that will appear in the income statement but not in the budget, that is amounts where there was no outflow or inflow of money. It's calculated amounts. So that would be depreciation, bad debts, discount allowed, discount received. So those income and expenses will increase the profit or decrease the profit that I calculate in the income statement. Not one of them is actual money that came in or out of the bank account, so they will not appear in the budget.